There's really one question you ought to be asking yourself just before you actually commit to dividend investing and choosing a dividend investing strategy. And that question comes down to what the heck are you investing for? Now, believe it or not, there are no real right answers to this question, but we do have to be honest with ourselves about this particular question if we really want to level up as dividend investors. And just drawing on a personal mistake, or rather several personal dividend investing mistakes that I made, I'm here to set the record straight for myself. I'm here to commit to some course correcting, and then most importantly is actually just sharing everything that I can with you so you can totally avoid all the mistakes that I made and hopefully reap the real rewards of dividend investing much earlier than I did. Moreover, I can honestly share with all of you that getting real with myself about why I'm dividend investing didn't only change my entire outlook on dividends, but led me down a path of rethinking my personal dividend investing strategy. And now today, because of all the hard questioning and decisive action that came thereafter, I'm sitting on north of $221,000 just in my brokerage account alone because I dared to actually get real with myself. So again, what on earth are you actually dividend investing for? Perhaps it's because you're gunning for financial freedom. Maybe you want to retire early, or maybe you want some passive income to help you with groceries, or just simply have more pocket money to actually enjoy. Or for some of you, getting really honest with yourself may just come down to you actually self-promoting as someone who's basking in the passive income river streams. Perhaps this is an addiction, or maybe receiving dividends is actually the thing that keeps you motivated. Whatever you're dividend investing for is fine by me. But I just want you to be clear on it, because if you're anything like me, someone who's really hungry for financial freedom, someone who really wants to retire earlier rather than later, and most importantly, someone who is making all the sacrifices in the world to make this all happen, then you shouldn't be here playing games and investing into high dividend stocks when you should in fact be oriented more towards growth, or vice versa. You might be ramping up on dividend growth stocks when you really ought to be playing it much safer with some higher yielding dividend stocks. Now, this all really comes down to coming to an understanding of your investor profile, which factors in first and foremost your age, but also your investment timeline. So how long you're actually going to allow your capital to remain invested, as well as your risk tolerance. So I just want to go ahead and look at a few examples with you so we can really go all in here and be on the same page in terms of setting ourselves up for success. Let's start with avatar number one, the early 20s wannabe passive income or dividend income millionaire by age 30. This investor is typically unexperienced but incredibly excited about investing, very hungry for dividends, and therefore seeking out the highest of paying dividend yield stocks. However, this investor's fate is sealed as a rags to TJ Maxx riches success story. I'm not here to say that higher yielding dividend stocks don't deliver on growth, but throwing a blanketed objective statement out there for all of you to chew on, they are not the right fit for this young investor in their 20s. Now, a perfect stock example here would be Verizon, whereas it will likely remain an outstanding company, but clicking to the stock chart, you could see for yourself that its impressive year-to-date appreciation of over 13% is actually quite dismal once you click into the 5-year view and only see that it's down by 27%. However, go ahead and click on Max View to see the exact proof that we need to understand why we should be looking elsewhere as a younger investor. Verizon was trading for about $60 back in 1999 and has never really popped above that share price, though coming close in 2020 before faltering back down to $43 per share today. So sure, perhaps a 6+% dividend yield is exciting and incredibly attractive, but in regards to total return, which is what we all should be after, Verizon is a no-go for me, at least as of right now. But if you're busy avoiding all the high-paying dividend stocks at this stage, then where exactly should you be looking? Well, personally, as of this video, I am a 30-year-old investor with decades of time to be invested in the stock market, and I'm personally looking to the Visas and United Healths of the world. Now, I just snagged about $5,000 worth of United Health the other day and only plan to grow this position to over 100 shares in my portfolio as a stock in focus for 2025. Likewise with Visa. But keeping to United Health, we can go ahead and click into their stock chart and discover year-to-date It's only up by about 5.6%. However, we would be in this gem for the long term, talking about decades on decades. And with that mentality, we'll click to the 5-year view to see over 130% worth of appreciation. Let's go one step further here to click on the max view to see over 406,000% worth of appreciation. Now, in comparison here to Verizon, well, Verizon may have won the battle on the year, but lost the entire war over the 5-year period in duration of their lifespan. Not to mention, having your dollar compound with a dividend growth stock will yield you much more than a high-paying dividend stock right now. It's really a matter of just delaying that instant gratification, holding out for a moment or second or days or months or years longer to actually achieve more. Now, if you're in your 30s like me, or even in your 40s, you're really still in a position to orient yourself towards more growth, but you can do so with dividend stocks that are paying a little higher of a yield. Maybe your Procter & Gamble's or your Home Depots of the world that yield 2+% in terms of dividend yields, which we can actually throw up now on the screen for our comparison. And we're going to again see that they still outbeat your Verizon type of investment and reward you more in terms of total return at the end of the day. Now, I say this to those of you who are out there nearly or already in retirement. You have my full support and even my encouragement to seek out high yield dividend stocks, as you most likely lack the time to actually reap the rewards of dividend growth compounding, but more importantly and more so because you may just be in the position to need more income right now, or simply desire the stability, which is what again you need. These would be your Verizons, Philip Morris's, Realty Incomes, and Dow Chemical plays of the world, delivering through on yields of 6.16%, 4.49%, 4.89%, and 5.27% respectively. But investors, I'm going to leave you with just one question now for you to really think about, mull over, and answer for yourself as a dividend investor. What the heck are you dividend investing for? Because if it is in fact to actually get the job of financial freedom done and done right, then I implore you to check out how you're actually investing currently and adjust immediately if need be. If you're brave enough to drop your answer to that question in the comments below, go ahead and do so now, but definitely be sure to check out this video right here if you don't already have $100,000 in your brokerage account, as it's meant to help you achieve that milestone much faster. Of course, subscribe if you're not already a part of the community. But until the next video, I will see you all there.